Okay, let's unpack this. Today, we're taking a deep dive into the latest financial results of Ola Electric Mobility Ltd for Q1 FY26.
Hmm.
If you're looking for a shortcut to truly understand what's happening behind the scenes with one of India's major EV players and why their recent shifts matter, well, you're in precisely the right place.
Absolutely. And what's really fascinating here is how these numbers, they reflect not just, a financial recovery, but a pretty significant strategic pivot.
A pivot, right.
Yeah, in a really rapidly evolving industry. So our mission today is to distill the key takeaways, everything from their financial health to their cutting-edge tech advancements.
And why it all matters for you and the wider EV market.
Exactly.
So let's kick things off with the big headlines from Ola Electric's Q1 FY23 results. We're looking at consolidated revenue from operations hitting 828 crores.
Which is quite a jump.
Yeah, a really strong 35.5% increase compared to 611 crores in the previous quarter, Q4 FY25. And on the delivery front, they pushed out 68,192 electric two-wheelers.
Also up significantly.
Yeah, that's a solid 32.7% increase quarter over quarter from about 51,000 units in Q4. So what for these top line numbers?
Well, if we connect this to the bigger picture, the real story here isn't just the growth itself, impressive as it is, it's the leap in profitability that's happening alongside it.
Okay.
The automotive segment, specifically, turned EBITDA positive in June 2025.
Wow, okay. That's a milestone.
It's a huge milestone. I mean, for a capital-intensive EV company that was, let's be honest, deeply in the red just quarters ago,
Right.
hitting EBITDA positive signals a massive turnaround. It suggests their underlying business model is, well, finally starting to sustain itself.
And how does that margin look compared to before?
Oh, dramatically better. Their auto EBITDA margin improved from a really challenging minus 90.6% in Q4 FY25.
Minus 90. So losing almost a rupee for every rupee of revenue before interest and taxes.
Exactly. Before all of that, now it's at a much healthier, though still negative, minus 11.6% this quarter.
Still negative, but a world of difference.
A world of difference. And we see a similar, though maybe less dramatic, recovery on the consolidated level, too. That improved from minus 113.9% to minus 28.6%.
Okay, and maybe the most compelling story isn't just revenue, but how they're improving profitability on each vehicle sold.
Yeah.
Let's talk gross margins.
Yes, that's where it gets really interesting. The auto gross margin hit 25.6%.
25.6%. That's their best ever.
Their best gross margin performance ever, yeah. And they're even projecting this could rise further.
How much further?
They're talking maybe between 35% and 40% once the production-linked incentive, the PLI benefits, kick in from Q2.
Okay, so those PLI benefits, that's government incentives boosting domestic manufacturing.
Exactly. So they'll directly help Ola's bottom line. It's like a subsidy on part of the production cost.
Right. Which raises the question, how did they achieve such a sharp improvement even before the PLI fully kicks in?
That's a really important question. A key factor is this aggressive cost optimization initiative they called Project Laksha.
Project Laksha, okay.
This program successfully slashed their monthly auto operating expenses, their OPEX, from 178 crores back in Q3 FY25
Yeah.
down to just 105 crores now.
Wow, that's a big cut.
It is. And even consolidated OPEX is now around 150 crores per month, and they have a target to bring that down further, maybe to around 130 crores per month by the end of this fiscal year, FY26.
That's a significant drop in OPEX. Can you give us a sort of tangible example? How do you cut costs that much without, impacting quality or something?
Yeah, good point. It's probably less about cutting corners and more about really optimizing their whole production and operational setup.
Okay.
So a big part of Project Lakshya involved things like standardizing parts across different scooter models,
Makes sense.
optimizing their assembly lines for better efficiency, and using their scale to negotiate better prices with suppliers. They've also streamlined service operations, logistics. It's a holistic thing.
Got it. A holistic approach to efficiency. So all these improvements, the sales growth, it should hopefully mean better cash flow. What's the picture there?
The cash flow picture definitely shows significant improvement, which is, crucial for a manufacturing business like this.
Right.
The auto business was actually nearly neutral on operating cash flow in Q1 FY26.
Nearly neutral already.
Almost. Which means their core EV operations are close to generating enough cash to cover their day-to-day running costs.
Okay.
And their free cash flow, or SCF, that also saw a substantial improvement. It came in at minus 107 crores for the auto segment, and minus 282 crores consolidated. Now, that's a marked improvement from minus 455 crores just in Q4.
Still negative FCF, but moving strongly in the right direction.
Exactly. And they anticipate the auto business operating cash flow will actually turn positive later in FY26. That's a huge step towards financial independence.
Okay, so beyond these impressive financial figures, the real proof is always how the products are resonating, right? What's happening with product adoption? Are people buying these things?
Well, what's really compelling here is the strong customer traction they're seeing, especially for the new products.
Like the Gen 3.
Exactly. The newly introduced Gen 3 scooters now account for almost 80% of their total scooter sales.
80%, that's huge.
It is. And it's not just about volume. The Gen 3 has delivered better margins, like we discussed, but critically significantly reduced warranty claims.
Ah, okay. That's important. How much lower?
Get this. Gen 3 claims are reportedly 60% lower than Gen 2.
60%.
And Gen 2 claims were already 30% lower than the original Gen 1. They estimate Gen 3 has the lowest fault rates in the industry now.
That 60% drop must be a massive relief for them service-wise, and a big trust builder for customers, too.
Absolutely. It's not just a number. It has real operational and reputational impact.
So that's a powerful statement on quality improvement. What else is exciting beyond the scooters? Any updates on motorcycles or software?
Yeah, the rollout of their Roadster X motorcycles is progressing. They say it's now available in 200 stores.
Okay.
And another, I think, notable highlight is the surge in adoption for their Movos Plus software package.
Oh, yeah. How's that doing?
This quarter, nearly 50% of new customers purchased this software package. That's a huge jump from just 2% in Q4 FY25.
Wow. 2% to nearly 50%.
Yeah. And this isn't just high-margin revenue, though it is that. It also indicates strong customer engagement with their whole tech ecosystem, right? It suggests they're building stickiness beyond just the hardware.
Right. Getting people invested in the platform. Now, you mentioned warranty claims dropping, but people might recall some past concerns, quite public ones, around warranty costs. So with this big drop in Gen 3 claims, what does this mean for those older issues? How are they tackling that structurally?
Yeah, that's an excellent question, and it seems they're addressing it pretty directly. Back in Q4. But the real engineering fix, it seems, lies in the motors. Their own in-house mid-mount motor, which they used in the Gen 2 S1 Pro, apparently has a 90% lower failure rate than the supplier-sourced hub motor used in some Gen 1 and early Gen 2 models.
90% lower. That's huge.
It is. And now in Gen 3, all the motors and controllers are their own in-house mid-mount design with attached controllers. So that further cuts failure rates and naturally the warranty claim costs. It feels like a systemic fix.
Okay, so that shift to in-house motors seems key. And this brings us to where Ola Electric really seems to show its long-term vision, right? This commitment to innovation beyond just assembly.
Absolutely. It's not just about buying parts off the shelf.
No.
What's really insightful, I think, is their deep investment in vertical integration that positions them pretty uniquely.
Give us an example.
Okay, well, they've successfully developed heavy rare earth-free motors, HRE-free.
Heavy rare earth-free. Why is that a big deal?
It's a huge deal.
Yeah.
Because rare earth materials are not only costly, but their supply chains can be, let's say, geopolitically sensitive.
Ah, okay. Supply chain risk.
Exactly. So developing motors without them is a strategic move. It addresses long-term risk, ensures business continuity, leads to cost savings eventually.
And performance.
They say it offers performance parity with traditional rare earth motors. Production deployment for these is scheduled for Q3 FY26.
Interesting. Okay, and what about on the safety front? That's always critical for EVs.
Right. On safety, they point out they're currently the only major EV two-wheeler company in India offering an ABS-equipped product, the S1 Pro Plus BS.
With ABS anti-lock braking.
Correct. But they're not stopping there. They also have an in-house ABS system under development.
Their own ABS.
Yeah, which they say will be ready by the January 2026 regulatory transition timeline. So that enhances their competitive edge and, again, gives them more margin control as they won't rely on external suppliers for that crucial safety tech.
Okay, in-house motors, in-house ABS. This leads to what feels like maybe the biggest piece of this vertical integration puzzle, their battery strategy.
Yes.
What's the latest with their really ambitious in-house cell manufacturing?
If we connect this to the bigger picture,
Yeah,
their in-house 4680 hard cell is potentially a massive game changer.
the 4680 cell, that's the format, right? 46 millimeter by 80 millimeter?
That's the one. It's a larger, more energy-dense cylindrical format. known for potentially reducing pack costs and improving range compared to smaller cells like the common 2170s.
And they're actually making them now?
They say they are ready in producing cells for their vehicles, with deliveries using these cells starting this Navratri.
Okay, wow. So the transition from supplier cells is happening now.
It'll be phased through FY26, they say. They expect to fully use their initial 1.4 gigawatt capacity by the end of FY26, and then scale consumption up to 5 gigawatts through FY27. The budget for that full 5 gigawatt plant is 2,800 crores, and they've apparently already invested 1,500 crores of that.
Significant investment. So technically, what makes their 4680 cell stand out? What's the edge?
Well, according to them, their current 4680 cell is already about 10% better in energy density than state-of-the-art 2170 cells.
10% more energy density. That
Yeah.
means more range or power for the same size battery.
Essentially, yes. A significant leap. And they're not stopping there. They're apparently already testing a V2 version with another 10-15% higher energy density.
Yeah.
And also an LFP, a lithium iron phosphate version, both targeted for late next year.
LFP is interesting for cost and longevity, too.
Exactly. So this relentless focus on in-house battery tech is clearly designed to cut costs, boost performance, and crucially improve their supply chain resilience. It gives them a distinct advantage, potentially, in a market often hit by battery constraints.
Okay, so looking ahead then, what's Ola Electric's roadmap and financial outlook for the rest of FY26? What are they actually projecting?
They've provided some pretty strong guidance for FY26. They're expecting volume somewhere between 325,000 and 375,000 vehicles.
Okay, quite a range, but substantial numbers.
Yeah, and revenue projected between 4,200 and 4,700 crores.
Right.
And importantly, they anticipate the auto business being EBITDA positive from Q2 onwards. So starting now, basically, targeting over 5% positive EBITDA for the full year.
Full year positive EBITDA for auto.
That's the goal. And furthermore, they expect the auto business to start generating positive free cash flow by the end of FY26, which, as we said, that's a critical milestone for long-term health.
That is an ambitious roadmap, especially given how capital-intensive this business is, which, raises the obvious question, are they actually well-funded for all this, or will they need more cash soon?
Yeah, very fair question. They stated that at the end of June, they held a cash balance of 397 crores.
Okay, about 3,200 crores.
Yeah, which they state is sufficient for their operating needs for this year and next.
Sufficient for now.
And perhaps hedging their bets or planning ahead, they have also approved a resolution to potentially raise up to 1,700 crores through non-convertible debentures and other debt securities.
Okay, so they have cash, and they have board approval to raise more debt if needed. Seems proactive.
It indicates they're thinking about liquidity to execute these plans without immediate pressure, yes.
So what does this all mean for their sort of overall strategy in this evolving EV market? Is it still just pedal to the metal expansion, or is something changing?
There's definitely been a strategic pivot, it seems, over the last 2 quarters especially.
Okay.
They appear to have shifted from that really aggressive market penetration phase.
Right, the land grab phase.
Kind of, yeah, to what they're now calling a balanced, profitable growth phase.
Balanced, profitable growth. What does that mean in practice?
Well, it seems they've recognized that after converting a lot of the early adopters, the tech enthusiasts,
Yeah.
the focus now needs to shift to converting the middle mass customers, the everyday commuters looking for reliable, affordable, quality EVs.
The mainstream buyer.
Exactly. And that means consolidating operations, really focusing intensely on improving those margins we talked about, and carefully expanding their product portfolio and distribution network for this next broader phase of growth. It's about sustainable scale now, not just scale at any cost.
Right, maturity setting in, perhaps. And finally, just to cover all bases, for listeners who might have followed some public reports, what about those inquiries from the CCPA and NSC regarding sales data? Any impact there?
Yeah, they addressed that. The company confirmed they responded to all inquiries from the Central Consumer Protection Authority about consumer grievances and also the National Stock Exchange about some variances in reported vehicle sales data.
Okay. And their stance?
Management explicitly states they do not expect any material impact from these communications on their financial results. They seem to view them as sort of standard regulatory back and forth that they've addressed.
Got it. So we've definitely unpacked a truly transformative quarter for Ola Electric here, delving into that financial turnaround, the product innovation, and this really deep strategic commitment to vertical integration and in-house tech. It's clear they're not just growing anymore, but really fundamentally reshaping their operations for sustainable, profitable expansion, it seems.
It really seems that way. So as you consider Ola Electric's journey, maybe think about this.
Yeah.
How might this discipline pivot towards profitability combined with that deep investment in fundamental in-house technology like their HRE-free motors, their Parat cells?
Yeah.
How might that fundamentally reshape not just their path, but the whole EV landscape in India over the next few years? What kind of ripple effect could that create for the industry's supply chains, for pricing, maybe even, for your next vehicle purchase? It's definitely a fascinating model to watch unfold.